SanDisk is riding an unprecedented wave of AI-driven profitability, generating colossal cash flows and aggressively deleveraging its balance sheet, yet simultaneously cementing a staggering $1.2 billion future financial commitment to a single critical supply chain partner. This creates a profound paradox: immense present strength intertwined with substantial future dependency. But does this signal long-term security or a hidden financial trap for investors in plain sight? We're about to unpack this with a deep dive into fundamental analysis, exploring what truly matters for your investing strategy. Gross margin expansion of an astonishing $860 billion to 50.9%, coupled with a 672% surge in net income, immediately captures attention. A basis point, by the way, is simply 1/100th of a percentage point. So that means increase in their gross margin. Think of gross margin as the profit left before you pay for rent, salaries, or marketing. It's the raw earnings from each sale after the direct costs of making the product. At first glance, the mainstream narrative shouts supercycle, pointing to the 36% rise in average selling prices per gigabyte as proof of SanDisk's market dominance. But when we look under the hood, the picture shifts. This explosive profitability is directly fueling a colossal $1.2 billion cash outflow committed to Kioxia, their critical joint venture partner. The twist? This current market advantage is effectively pre-financing future strategic obligations, meaning a significant portion of what looks like free profit is already allocated. The investor's lesson here is clear. Don't just celebrate current profit fireworks. Trace where that capital is actually flowing and what future flexibility it constrains. This is exactly why your portfolio might feel stagnant, despite what the headlines scream about booming sectors. And this brings us to the real engine behind SanDisk's current success, the AI infrastructure catalyst. The data center segment delivered a stunning 76% year-over-year growth. The common view is that this is simply unstoppable AI demand, a golden ticket. Yet the critical question we must ask is whether this growth is sustainable and, crucially, whether it is the sole engine. This segment is undeniably the primary bellwether, heavily influencing current market dynamics. The twist, however, lies in its concentration. Extreme reliance on one high-demand niche, no matter how powerful, creates a single point of failure. It's a crucial insight for any stock market analysis. The investor's lesson: while riding a secular trend is powerful, true resilience comes from diversified growth drivers, mitigating the risk if that single trend falters or competition intensifies. Next, let's dissect SanDisk's incredible cash generation. The company boasts $1.418 billion in 6-month free cash flow, translating to an impressive 26.6% free cash flow margin. Free cash flow is the actual cash a company generates after paying for all its operating expenses and capital investments. It's the cash truly available to pay down debt, buy back shares, or invest in new ventures. On the surface, this screams cash flow king. It comfortably exceeds reported net income, indicating robust operational efficiency. But how free is this cash when a substantial $1.2 billion is already earmarked for strategic agreements with Kioxia to be paid between 2026 and 2029? The twist: exceptional cash generation doesn't automatically translate into unconstrained capital allocation flexibility. This significant future commitment acts as a preemption, potentially limiting SanDisk's ability to pursue other high-return initiatives or directly return capital to shareholders in the near term, a frustration often felt by investors who only look at the top-line cash figure. The golden rule here is to understand the difference between cash generated and cash available for discretionary deployment. This is a simple rule, but it's incredibly powerful for sound investing strategy. This leads us directly to the apparent financial prudence of deleveraging. SanDisk executed an aggressive $1.25 billion debt paydown, slashing its debt-to-equity ratio to a remarkably conservative 0.59x. The debt-to-equity ratio tells you how much debt a company uses to finance its assets, compared to the value of its shareholder equity. A low ratio like this one often signals financial stability. The immediate celebratory interpretation is that this massively de-risks the balance sheet, freeing up capital. But the twist is that this deleveraging can be seen as an imperative, a strategic clearing of the decks. It's creating financial capacity for those unavoidable future obligations to its joint venture partner and increased capital expenditures, rather than purely optimizing shareholder returns or future acquisitions. The investor's lesson: sometimes what looks like purely proactive financial strengthening is actually foundational work for unavoidable future commitments, a crucial distinction often missed by those who only glance at financial headlines. This is core to value investing. Now consider the single supply chain thread. SanDisk's deep strategic partnership with Flash Ventures, or Kioxia, means reliance on them for substantially all NAND flash memory wafers. Think of NAND flash as the microscopic building blocks of digital storage found in your phone, computer, and data centers. The recent extension of these joint venture agreements through December 31st, 2034, and the accompanying financial commitment solidify this relationship for the long term. The surface-level comfort is secured supply. The twist: this is a critical single point of failure risk. Any operational disruptions, policy shifts, or regional tensions affecting Kioxia could severely impact SanDisk. It's an operational model that, while efficient, is potentially more fragile than it appears. What does this mean for your portfolio? Understanding supply chain concentration isn't just an analyst's detail. It's a fundamental assessment of operational vulnerability, a solution to avoiding unforeseen shocks. Once you grasp this, you'll start to look at financial reports in a completely new light. Adding another layer of complexity, management has explicitly flagged policy shifts and the risk of new tariffs as an immediate concern for 2025, warning that existing exemptions could be revoked. The common investor sentiment might dismiss this as macro noise. But the twist is profound. Any increase in the cost of revenue due to these shifts could directly erode that impressive 960 basis points of gross margin expansion. It challenges the very foundation of SanDisk's current profitability profile. This is exactly why relying on just one quarter's performance is dangerous. External policy risks are as critical as internal operational efficiency. This is something you can easily check for yourself in any company's risk disclosures. Finally, we must acknowledge the price of innovation and expansion. Management has guided for higher capital expenditures, or CapEx, in fiscal year 2026 to transition to newer memory nodes, alongside increased research and development spending. Capital expenditures are funds used by a company to acquire, upgrade, and maintain physical assets. These are essential investments for maintaining technological leadership. But here's the twist. These capital-intensive investments will compete directly with the $1.2 billion Kioxia commitment for available free cash flow. It creates a complex balancing act between securing future competitiveness and managing significant immediate financial demands. The investor's lesson: essential innovation is never free, and its cost must be evaluated against all other cash demands, not just in isolation. This is key to comprehensive fundamental analysis. Beyond the revenue and profit fireworks, SanDisk maintains a robust balance sheet, boasting $1.539 billion in cash and a strong current ratio of 3.1x. The current ratio, think of it as a quick snapshot of a company's immediate financial health, measuring how easily it can cover its short-term bills with its current assets. This undoubtedly provides an underlying safety cushion, enabling the company to navigate market volatility and strategic shifts without undue strain, even with future cash commitments and potential tax indemnification liabilities of $128 million to Western Digital. These liabilities are basically a guarantee to compensate another party for losses if specific tax events occur. So, returning to our opening question, is SanDisk's paradoxical dance between immense present strength and substantial future dependency a sign of long-term security or a hidden financial trap? The ultimate truth is that SanDisk has strategically leveraged a current market supercycle to de-risk its balance sheet while simultaneously securing its most critical supply chain for the long term. This isn't a trap, but a calculated, albeit constrained, strategic maneuver. They are consolidating their future at a steep pre-committed price. That's why I believe that while SanDisk's financial prudence and strategic foresight are commendable, the market will soon shift its focus from the current profit surge to the formidable future cash allocation challenges, fundamentally re-evaluating the true, free nature of its cash flow within the next 18 months. This is crucial for any astute investing strategy. But I want to hear your take. Does SanDisk's long-term commitment to Kioxia make you more or less confident in their future performance? Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.